Now, several lawmakers are under fire for selling major holdings at the beginning of this stock market sell-off.
So I had no knowledge of these companies, and in fact, it was a mix of buys and sells.
We have a free market economy that should be able to participate.
We didn't realize that insider trading was happening every day.
Or they can pick a different line of work.
Hey guys, welcome back to another installment of Financial Fool-Around, the show only marginally worse than watching paint dry. Today, we'll be looking to emulate the best investors on the face of the planet, hedge fund managers.
You're wrong.
People selling trading courses.
No.
YouTube day traders.
What? Bro, what are you talking about, man?
Redditors on Wall Street bets.
Stop the cap.
Members of US Congress. That's right, despite having essentially no experience in finance, senators, according to this landmark paper, return, quote, abnormal returns from common stock investments. How abnormal? Well, senators return 12% above the market, which doesn't sound particularly impressive until you remember that Warren Buffett, the investor you pretend to know, only returns a measly 2.5% above the market. But what happens when we try to copy the trades of these senators? First, we need to get the investment data from these senators. And after knocking at Turtle Boy Mitch McConnell's house and asking him for insider tips, we run into our first problem. While theoretically, senators are forced into disclosing their trades, disclosure is only required 45 days after the trade has been completed. To understand why waiting 45 days is a problem, we have to understand why senators make such good returns, and we have to fully grasp how long 45 days is. Tackling the why of why senators get such stellar returns is easy. Obviously, these astronomical returns are the results of dedicated learning, years of hard work, committed studying on the part of US Congress. Picture Chuck Schumer learning about leverage from Bill Hwan, Mitch McConnell practicing the teachings of Jim Cramer, and Nancy Pelosi, Nancy Pelosi doing nothing, because when is the last time a Democrat actually got anything done? Facetiousness aside, the why comes down to several factors. First is the powerful social network that arises from becoming an elected official. Days previously spent wondering whether having no redeeming qualities disqualifies you from politics are instead filled with meetings with CEOs, titans of industry, and people whose decisions can move markets. It's therefore only natural to come away from these encounters with at least some useful information. The second and most important factor is the knowledge of government actions before government does them. Obviously, the actions of federal government have a massive implication on the price of stocks, on the price of companies, and on general performance of the economy. For example, let's say it's early 2020 and the public has not yet grasped how massive coronavirus will be, but you receive briefings as a government official about its severity way before the public. That's useful, non-material public information right there. Now that we've established that members of Congress can and do stumble onto useful information from time to time, how can we be certain that these members of Congress will act on it? For that, we refer to public choice theory, which postulates that we should view governmental decision-making as a result of the actions of individual, self-interested public policy actors like members of Congress. This means that senators will use their positions to maximize utility in their private lives. Imagine stealing a pen from work or using the company phone for anything other than business. But in this case, it's not a pen or phone, it's non-material public information. Now that we've contextualized how members of Congress achieve such stellar returns, we can now understand why waiting 45 days is actually a disaster. 45 days is an eternity in the world of finance. Just ask anyone over at Wall Street Bets who've seen people lose absolutely everything in far less than 45 days. But But I guess the real question is 45 days enough to neutralize the informational advantage that senators have? And I argue that it, in fact, isn't. And here's why I think that. First, we have to consider the fact that disclosure is required, and therefore those trades are going to be scrutinized. Senators, in fact, know this and are therefore incentivized to not trade on short-term trading tips, because then it becomes too blatant that they've got insider information. I mean, just think about it. You don't want the SEC at your door just because you made a trade one day before a major announcement. Rather, I propose that senators only act on long-term tips, because it's much harder to verify if there's insider information if you buy shares and only 9 months later the price goes up. Imagine buying Dogecoin a year before Elon Musk tweets about it. The SEC isn't going to suspect that you knew he was going to tweet about it because it happened over a year ago. But the SEC is never going to be like, oh, you totally saw this coming, you know? And therefore, I hypothesize that we can invest at time of disclosure and not fear missing out on any gains, because senators are forced to only act on long-term tips. And so with all of that out of the way, we can finally get to executing trades and crafting the perfect strategy.
Finally!
Copying senator purchases and holding them for exactly a day, then selling them, gives us this graph. This graph surprises me a little, as I would have thought disclosure from senators creates a buying pressure, increasing the share price in the same way Warren Buffett's disclosure increases the short-term share price of a company he invests in. For a week, we get this graph, nothing significant. For a month, we get this graph, nothing significant. And for a year, we get this graph, good returns, but we already knew that, so nothing significant. Now, we're going through these quickly because they don't tell the real story. The graph that tells the real story is this one. This is the graph where we break down that 12.4 into who is listed as the investor. See, what's interesting about senators is that they're not only required to disclose their trades, they're also required to disclose the trades of immediate family members. And immediately the story becomes clear. As we've already established, senators can't trade on short-term tips because they can't risk getting caught by the SEC. But in reality, they also can't trade too recklessly with long-term tips, because you start trading a little bit too well and suddenly the SEC is at your door. So then what do you do if you're a senator in this position? Well, the answer is obvious. You give the really good trading tips to your wife, while you take on the more unreliable risky. And I wager this is why we see such a massive difference between the returns of spouses and the senator themselves. In particular, I say spouses because even though child returns are higher, child trades only account for 2% of total trades, while spouses account for 37%. So we can come to the conclusion that senators use their family members to hide their best trades. But senators aren't stupid. They know that they'd have to disclose their best trades if they gave them to their spouses or their children. So, how deep does the rabbit hole go? If the spouses perform so well, what about the brothers, the sisters, the nieces, the nephews, the people that don't have to be included on the disclosure? That part is pure speculation though. The only conclusion that I think we can reasonably come to is that the spouses and the children get better trades, and that must be for some tangible reason. What does this all mean? It means that we can craft a perfectly reasonable strategy just copying the trades of US senators. More specifically, we can even optimize the strategy a little bit further by copying the trades of their spouse and the trades of their child. Anyway guys, thanks for watching, and I will catch you next time.